Hey everyone, today we still gonna talk about Nvidia. I know Nvidia keeps popping up in the news so often. It seems like every day you hear about their stock going up, chips being in short supply, or their products being incredibly expensive. Recently, Nvidia announced its Q2 financial results for the period ending July 28, 2024. Nvidia's revenue reached $30 billion, a staggering 122% year-on-year growth, and their net profit was $16.6 billion, up 168%. Even more mind-blowing is their gross profit margin, which hit 75.7%. To give you some perspective, in the world of high-end manufacturing, only industries with low marginal costs, like software development, can reach a margin of around 70%. For hardware manufacturing, surpassing 70% is truly remarkable. Now, let's take a look at Nvidia's market share. They hold a 98% share in the GPU market and 88% of the global standalone graphics card market. In comparison, AMD, their closest competitor, only holds 12%, and Intel barely even registers with a market share of less than 1%. Monopoly is one of the biggest concerns in business today. So, the question I find myself thinking about is, how could Nvidia's dominance in the chip market be challenged? Or to be more provocative, what could bring Nvidia to its knees? Okay, maybe that's too extreme. Let's rephrase. What risks might Nvidia face in the future? Let me throw out a few ideas and get the conversation started. Nvidia is primarily a chip design company, while the production of those chips is outsourced to semiconductor foundries. So, who is Nvidia's biggest supplier? Most of you can probably guess. Yes, it's TSMC, Taiwan Semiconductor Manufacturing Company. TSMC is Nvidia's main manufacturing partner, responsible for producing the vast majority of their high-performance GPUs. Although Nvidia hasn't publicly disclosed exact figures, it's widely estimated that over 90% of Nvidia's chips are made by TSMC, with Samsung handling a small portion to supplement production capacity. Why does Nvidia trust TSMC so much? It's simple. TSMC leads the world in chip manufacturing stability and yield rates. At the same manufacturing node, TSMC consistently delivers higher yield rates and more stable chip performance. Another key point is that TSMC focuses solely on contract manufacturing and doesn't produce its own branded chips, so there's no risk of competition with its clients, making it easier to share advanced designs and technologies. This brings us to Nvidia's first risk: their heavy reliance on a single supplier for cutting-edge chip production. If TSMC faces production issues, technological bottlenecks, or geopolitical conflicts, Nvidia's chip supply could be disrupted, affecting product deliveries and market share. Additionally, Nvidia CEO Jensen Huang has announced that the company would release new chips from a 2-year cycle to a 1-year cycle. This faster pace means TSMC will need to ramp up its existing production capacity, but building a new factory takes at least 18 months and requires an investment of around $20 billion. This is a significant commitment for TSMC, and their expansion timeline doesn't necessarily align with Nvidia's. Finding another supplier that can match TSMC's quality and scale isn't easy either. Recently, news broke that Nvidia delayed the delivery of their latest Blackwell chips, partly due to TSMC's packaging technology constraints. This just shows how interconnected their fortunes are. When it comes to the chip business, Nvidia's main competitors are AMD and Intel. Sure, you might think of companies like Apple, Google, and Tesla, which design their own chips, but they primarily use them for their own products, so they don't really shake up the wider market. AMD has made significant strides in recent years, but still hasn't managed to dethrone Nvidia's technical leadership in key areas. And Intel? Well, Intel's problems are more internal. Recently, Intel board member Lip Bhutan resigned, citing issues with the company's bloated structure and conservative approach to reform. It's hard to expect big results from a company stuck in such a rigid mindset. So today, I want to mention a startup that might challenge Nvidia in the future. According to Nvidia's latest financial report, 90% of their revenue comes from data centers. Digging deeper, it becomes clear that the surge in demand for generative AI has been a major driver of Nvidia's chip sales. If you followed our previous videos, you'll know that generative AI applications like ChatGPT and Midjourney relies heavily on the transformer model, as introduced in the Attention is All You Need paper. This model is built on a self-attention mechanism that requires massive computing power and memory, which is why Nvidia's powerful GPUs are so sought after. But, and this is a big but, Nvidia's GPUs are general-purpose computing chips, capable of handling a wide range of tasks. Recently, a startup called Etached developed a chip specifically designed to run transformer models called the Sohu chip. It claims to be the fastest transformer chip ever, running tasks several orders of magnitude faster than GPUs. In fact, it said that the Sohu chip's performance in running the El-Llama 70B model surpasses Nvidia's Blackwell-based B200 by 10 times, and the current Nvidia H100 by 20 times. Could this specialized approach to transformer models pose a challenge to Nvidia's dominance? In the future, more startups may emerge in the chip industry, and we'll have to wait and see if they can make waves. As demand for computing power continues to grow, many chip manufacturers are looking to increase chip size to boost processing capabilities, which is where the mega chip strategy comes in. But the bigger the chip, the more complex the manufacturing process. Nvidia's Blackwell chips use a combination of two of the largest chips ever produced. As the number of chips increases, so does the difficulty of development, growing exponentially. Nvidia has already admitted in its statements that there are yield issues with the Blackwell architecture GPUs. The company has had to tweak parts of the B200 processor's design to improve yield rates. This is one of the main reasons Nvidia has delayed the Blackwell chip deliveries. In this high-stakes game of mega chips, Nvidia's approach is a huge gamble, and only time will tell if it pays off. In conclusion, a great company must stand the test of time. But a company that continually raises product prices due to a monopoly on technology is frustrating for consumers. After all, it means higher costs for end users like us. A competitive market is always better for the average consumer. Alright, that's all for today. See you next time.